Had the authors of that document consulted history, they would have realized how extraordinary that decision was. If you go back to the last major regional contagious debt crisis, the so-called Latin American debt crisis in the early 1980s, the creditors that were involved at that time, they were commercial banks, they went to Washington in the summer of 1982, just before Mexico declared its moratorium, and they said to the official sector, the IMF, the US Treasury, the Federal Reserve, we don't have to have a crisis. Why don't you, the official sector, lend Mexico the money to repay us? Or alternatively, guarantee our loans to Mexico and all will be well. And they were told very sternly, you must face up manfully to your credit decisions. You lent the money. Why should the taxpayers of the United States and the rest of the world reimburse you for what turned out to be bad credit decisions? So they were told, no, you must reschedule. That is, you must extend the maturity of your loans. Until such time, and this was the propaganda of the day, until such time as this entire problem blows over, and Mexico, as well as the other, and there were another 23 countries that went into that dark tunnel in the 1980s, until those countries can grow out of the debt crisis. You see, the argument was a debt to GDP ratio has the numerator, the gross amount of the debt, and the denominator, the size of the gross domestic product that is supporting it. You can improve that ratio in one of two ways. To be sure, you could cut the numerator, cut the debt stock, alternatively increase the GDP, increase the growth, and it will become sustainable again. And the propaganda of the day was, this is a temporary problem, these countries will grow out of the debt crisis. No one said it at the time because it was inconsistent with the propaganda that this was a very temporary problem. No one said it at the time, but if you think about it, the truth was that by telling the banks that they had to reschedule, extend their loans, in effect you were grabbing them by the nose and you were pulling them forward into an uncertain future. One of two things awaited them in that uncertain future. Either the propaganda would turn out to be true, and as the decade would roll on, the crisis would diminish and the countries would grow out of the debt stock, in which case it would all be a bad dream. They would never have lost $1. Remember, all they did was stretch out. They did not haircut, they did not reduce the interest rate, they simply stretched out the maturity. So one of two things must be true. Either the optimists will be shown to have been correct, in which case all is well, or they will not, in which case at some point in that misty, gauzy future, a more severe form of debt restructuring is going to be required. But you see, the secret was, by grabbing the existing creditors and pulling them forward, if what awaited them in the future was a more severe debt restructuring, that axe would fall on the neck of the people who lent the money and not taxpayers who had repaid them at some earlier period. Well, we all know the history. In that misty future, there was an axe about to fall. It fell 8 years later. A Secretary of the Treasury by the name of Nicholas Brady was the one administering that haircut. There were haircuts, there were losses, but they fell upon the lenders who had lent the money. Moreover, during that 8-year period between 1982 and 1990, when Nick Brady appeared, the banks were told, you're overexposed, you ought to be provisioning your loan loss reserves. You ought to be cushioning yourself against the possibility that something bad could happen. The propaganda was, of course, nothing bad would happen. Everyone was going to grow out of the debt crisis. That was the propaganda. But the regulators made it clear that they should, to use the expression, be putting something away for a rainy day. It was Nick Brady in 1989 who stood up and said, "It's raining." Why should Europe have chosen such a dramatically different path with Greece in May of 2010? Why, in the face of those precedents, and there were dozens of them, why should they have said, no, this time we're not going to drag the lenders into the future? We are, in fact, going to use our taxpayer money to repay in full and on time every maturing bond. Understand, friends, those liabilities do not evaporate when they're paid out of the bailout money. They simply migrate out of the hands of the people who lent the money and into the hands of the official sector. If you wish to be dramatic about it, the liability migrates from the hands of the hedge fund in Berkeley Square in London and onto the shoulders of some Hausfrau in Stuttgart who paid her taxes last year. Why should they have done it? I think there were three motivations. The first, and to be sure the commanding one, was a benumbing dread of contagion. Remember, this is May of 2010. It had all just begun. And what worried them was this: if we restructured, if we didn't lend Greece the money to repay in full and on time and told them that they had to restructure these liabilities, might not the markets say, if you can do it for Greece, well, you could do it for Ireland, you could do it for Portugal, you could do it for Spain, you could do it for Italy, you could do it for La Belle France. So the fear of contagion was principally on their minds. Second motivation, unlike the debt crisis in Latin America, this was a situation in which the money that Greece owed on those bonds were principally held by commercial banks in Northern Europe. So if you said to Greece, restructure these bonds, you would inflict a balance sheet trauma upon Northern European banks. So if you wish to be cynical, you could say it is more politically palatable for Frau Merkel to lend Greece the money to repay its bonds owned by Commerzbank than it would be to have to recapitalize Commerzbank directly by allowing Greece to restructure the bonds. The final argument, final motivation was a purely theological one that existed at the ECB, and it was a fear that if history recorded that €1 of Eurozone sovereign debt had been restructured, that it would so indelibly stain the reputation of the euro itself that people would flee the euro, and the great monetary union experiment would be placed in jeopardy. Therefore, if Jean-Claude Trichet were here, Jean-Claude would have said then, would say even now, if the price of preserving this magnificent experiment is that we must monetize every debt instrument south of the River Rhine, it's a price worth paying. And so they began. 3/4 of what Greece borrowed under that bailout facility went to repay its bondholders as the bonds matured, relentlessly every month. They were paid in full and on time. Dawn comes late in the northern latitudes, but this dawn eventually broke over Berlin. They realized that if the Greek debt situation was unsustainable and a debt restructuring was inevitable, the policy that they had adopted in May of 2010 meant that when the axe fell, it would fall upon their own taxpayers' neck. And all of a sudden, the politically intolerable position that meant induced the official sector in one of the most, probably the most extraordinary shift of policy direction I've seen. They careened from a requirement that Greece not restructure any of its debt. They careened in the summer and fall of 2011 to the position of saying you must restructure what's left of your debt. And moreover, because so much of it had already been paid and moved to that Hausfrau in Stuttgart, what was left had to be afflicted with a very severe, savage debt restructuring. They said at least half of it must be written off, the rest of it rescheduled for 30 years. So in May of 2010, they had a choice between a debt restructuring and a gross bailout, a bailout that included all the money needed to repay existing creditors. They chose the gross bailout. They got the restructuring, and it was an ugly one. And because it had been delayed so long, it had to be particularly ugly. In the end, it was a 53.5% nominal haircut, a net present value loss of 79%, and in that decision, don't you see, friends, was the fate of the Cypriot banking system determined. The years have rolled sweetly on, and now the debt crisis did not evaporate as they promised it would. These countries have not been able to grow out of the debt crisis, partly as a result of the massive fiscal austerity they're being asked to endure, but to a large degree simply by the fact that this is not isolated. If it were one country or two countries encountering difficulties in a world that was prospering, they could export their way out of this. But when every country, from the United States to Western Europe, is in a recession, everyone wants to export more and import less, and that cannot happen. So the problem turned out to be more chronic than it was acute. Now, of course, there are question marks over countries like Spain and like Italy, where the amounts involved are incalculably larger than they are in Greece. Greece was the largest ever debt restructuring, a little more than 300 billion of euros of debt at the beginning. In the end, that debt restructuring I just described lopped off 100 billion euros from that debt stock, but it is still an unsustainable debt stock. It is even larger than when they started. So what are their options now? Understand how they analyze the problem. The they being the official sector. In their minds, what we have here is a temporal problem, a timing problem. These countries, Spain and Italy, for example, Cyprus, for example, have already embraced severe fiscal discipline programs. But not enough time has passed for the market to reward that fiscal discipline with lower interest rates on the bonds. In effect, they would say, the official sector would say, look, if we could fast forward for 2 years or 3 years, then you, the market, would see in hindsight that our commitment to fiscal austerity was indeed irreversible, and that the fiscal austerity, the rearrangement of the economy produced a much healthier borrower. We would return to creditworthiness again, and you will in the future reward us for that. How does a market reward a borrower? It's a lower interest rate, a lower coupon. So the argument goes, read my lips. I tell you that Spanish commitment to fiscal adjustment is irreversible. Read my lips, it is irreversible, and reward me now for that commitment. That's how they're analyzing the problem. It is a temporary problem and will be solved by fiscal adjustment over a relatively brief period. They have, I think, 5 options, but only 5. And I will rank these in order of the preference of the debtor country. The first option, the one we're in now, for countries like Spain and Italy, is essentially to jolly the markets, to give that speech, read my lips. Fiscal austerity, fiscal adjustment is irreversible. We will be creditworthy in a couple of years. In effect, to persuade the markets to engage in an act of faith, hope, and charity today on the strength of a politician's assurance that all will be well tomorrow. I don't think it really had much of a chance of succeeding. The second option, the one that they're about to move into, this one is very interesting, very clever, maybe too clever by half, we'll all find out. Under this option, an official sector player will come into the market, and the European Central Bank has volunteered for this role last September. They will come into the market and they will buy up in the secondary market bonds of the afflicted debtor country. And they will buy them in such quantity that they will drive down the yields, the implicit interest rates on those bonds in the secondary market. And that, the theory goes, will allow the country to issue in the primary market, that is, new issuances, new bonds, at interest rates that reflect this artificially manipulated lower yield. The best example is classical Greek drama, when a Greek playwright encountered a problem on the stage that was insoluble. They had a marvelous method for dealing with it. They would crank out a crane, quite literally a crane, over the stage, and a god would descend, and the god would fix the problem on the stage. It's known by the Latin deus ex machina, God from the machine, quite literally. Well, in Europe, this god has a name. His name is Mario. I'll come back to that. But if that program fails, in effect, using official sector resources to manipulate the market so that the country can continue, at least ostensibly, to have voluntary market access. If that fails, then market access is lost. And then there are only 3 options. Again, ranked in descending order of attractiveness to the debtor country. If market access is lost, the first thing the country will say is, give me a gross bailout. Give me what you gave Greece in the beginning. Give me the money to repay my bondholders. Why? Do not let me go into the history books as a defaulter on my bonds. Let me borrow, in effect, from your taxpayers to repay my creditors, a gross bailout. Before they shifted policy in Greece, Ireland got one of those, and so did Portugal, and they're still in place. So that's the preference. That will be the preference of the debtor country. If that fails, if the official sector says, no, we learned our lesson in Greece, we're not about to use our taxpayer money to repay your creditors and whitewash the bad credit decisions they made. If that is the official sector policy, the next option, the 4th option, is simply extend the maturities of those maturing bonds. Get them out of the program period. Push them down the road. It has a number of benefits. From the official sector standpoint, once they're pushed down the road, the official sector doesn't have to lend the money to repay them. That reduces the amount of the bailout loan. It avoids the political risk I described a moment ago. From the standpoint of the debtor country, it lets the Minister of Finance put his hand on his heart and give this speech. All ye who have lent to the Republic of Ruritania, I assure you every euro you lent will be repaid. It will be repaid at the interest rate that you lent it. It just won't be repaid quite when we said it would be. The fifth option, I'll put it on the table and then discard it. The fifth option would be to say, right now, let's go into a Greek-style debt restructuring. Let us bring the sword of the Lord to the debt stock. Let us haircut it. Let us reduce it. The purists, and there are purists, particularly at the IMF, would say the principal flaw with option 4, to use the market phrase, extend and pretend, they'll say the problem with option 4, obviously, is it does not address the debt sustainability problem. The debt to GDP will be precisely the same after you extend as before. So a purist would say if the debt stock is unsustainable, it needs a meat cleaver, and you must do that now. The fly in the buttermilk is this. Unlike Greece, which had only about a third of its debt stock in the hands of local financial institutions, countries like Spain and Italy and Cyprus have the majority, the vast majority of their debt now held by local financial institutions. So don't you see, if you did decide to haircut that debt in a Greek-style restructuring, you would decapitate your domestic financial system, meaning that every euro you saved in debt service is probably one you would have to borrow to recapitalize your own banking system. So it would be a futile endeavor. And that is the critical factual distinction between what happened in Greece and the situation of these other countries, including your country. What will they do? Well, they have the same decision again. And it is a decision that they must make, I think, within the next 2 months for Cyprus. The good news is the amounts of money involved in the global scheme are not significant. That's both good news and bad news. It is good news if you think that they will be disposed to a gross bailout and use their taxpayer money to allow you to repay your bonds in full. It won't be much taxpayer money. On the other hand, the size, the relatively small size, means that if you did, if they did insist that a restructuring of the people who lent the money was required, let us say an extension of maturities, that will not be a lethal balance sheet trauma to any Northern European bank. Amounts just aren't that large, so they don't have to worry about recapitalizing Commerzbank as a result of forcing a country like Greece to reschedule. They won't have to worry about that with Cyprus. They have learned from Greece that if they take these liabilities on their own shoulders, which they have now done, Greece started with more than 300 billion euros of debt owed to the private sector. It now has 31. 90% of it has either been written off or migrated into the hands of the Hausfrau in Stuttgart. The problem is, the day will come relatively soon when the debtor countries will say, look, we only have two choices. We must either remain a ward of the official sector. You folks in Northern Europe are going to have to continue supporting us because we have no market access. How can we have market access with a miasmic cloud of debt that hangs over our head, to be sure, owed to you, the official sector, and not to bondholders? But how can we possibly go to the market with that? So therefore, we're your ward for the foreseeable future. Or we must be made presentable for the market And the only way to do that is for you, the official sector, now to write off what you've lent to us or stretch it out until the crack of doom at a low interest rate so that the market will perceive us as creditworthy again. That cruel choice awaits them in the very near future, probably next year, when countries like Greece will be emerging from their programs and will say, we can't go back to the market on realistic terms. Perhaps Mario Draghi will be able to intervene for a while and manipulate things so that it appears we have market access, but in fact what Mario will be doing is slapping training wheels on the bicycle. Everyone will know that. He even has said that if he runs this program, he will publish how much he's bought. In the jargon of this business, that cruel choice has a name. It is called official sector involvement. The euphemisms in this business are worth a PhD thesis. Official sector involvement, OSI, that means that when the time comes, the official sector, having wisely or unwisely chosen to take upon itself the role of the sole creditor for these countries, must now face the consequence that in order to allow the countries to return to the market, they must endure the restructuring that they so improvidently saved private bondholders from having to endure. That will not happen, in my view, before the German elections in October. Mrs. Merkel does not want to go to her parliament and say, I was here a year ago to jolly you into lending money to these countries, only now to tell you that it's not going to be repaid back. But next year at this time, OSI, official sector involvement, I think will be what people will talk about. My guess, they will have a visceral aversion to haircutting what they lent. You see, their politicians are not going to want to say that they lost €1 of their taxpayer money, but stretching it out, stretch it out for 40 years, put a 2% interest rate on it, 2% higher than Germany's cost of funds. That allows Mrs. Merkel to say to her parliament, we will never lose one single euro. It shan't be paid back in my lifetime, maybe in my children's lifetime, but we will get it back. And we will get it back at an interest rate that at least today is higher than our cost of funds. Politically, in my judgment, that's the way it will shake out. But that discussion will wait until next year. Let me stop there and sit down and let you folks ask questions, because I'm sure you have them.
Thank you very much. Just three comments. We don't have time. The new government doesn't need to just walk. It needs to run, right? That I got out. With your permission, I'd like to give an invoice for 2.3 billion to Mr. Stavrakis, who borrowed short. And that's the 2.3 billion we're missing, right? Because we borrowed short. And no one's talking about it. No one has seen him. I think we should start asking, why the hell do we need another 2.3 billion in June and July? And the third one is, we have a narrowing range of options from the options that Lee so eloquently pointed out, but I think Mitu showed we have options. It's just our politicians don't know about them, right? They don't know about them because they've never hired international experts. Now, we should hire international experts. If we did when we were doing these debt contracts, we wouldn't be in this mess in the first place. So if you can now please close all recording devices. If you can, I'm